All right, have you ever wondered what really goes on in those few minutes right before a huge economic number drops? Today, we're doing something special. We're going to crack open a professional trader's secret playbook and see exactly how they handle one of the most volatile moments out there, the ADP Employment Report. Let's dive in. So, how do the pros really trade the news? Well, first things first, you gotta forget that Hollywood image, the trader with a gut feeling just slamming the buy button on a whim. The reality, it's way more calculated, it's way more disciplined, and honestly, it's a whole lot more interesting. It all starts with a completely different mindset. See, the real secret here isn't about being a fortune teller. It's not about guessing if the number is going to be good or bad. Who cares? It's about having a super detailed, rules-based plan that already knows what to do no matter what happens. The goal is to react, not to predict. And the core strategy they use for this specific trade? It's called a liquidity probe. So what on earth is a liquidity probe? Okay, think of it like this. You're at the edge of a pool, and you dip your toe in to check the water temperature before you jump in, right? That's it. The trader isn't making some massive, high-conviction bet on which way the market's going to go. Nope, they're just using a small, careful position to test the waters, to see if the market's initial reaction has any real power behind it. It's basically a low-risk, intelligence-gathering mission.
Okay, that brings us to the first part of this whole operation, the pre-market checklist. And let me tell you, this is absolutely crucial. The slide says it all. 80% of the work, the real edge, is found right here, long before that 8:15 a.m. number ever hits the screen. It is all about the prep work.
So, just like a pilot running through their pre-flight checks, a trader has a list that is absolutely non-negotiable. First up, you've got to map the battlefield. That means knowing all the key price levels from overnight and the day before. Next, you check the liquidity quality. Is the market behaving in an orderly way, or is it pure chaos? Then you analyze the gap. A massive price jump right before the news can kill the whole play before it even starts. And finally, the last check. And this one is the most important of them all. It's the one thing that can shut the entire trade down, period.
And that rule is all about the bond market. This is the ultimate green light or red light. You see, the stock market can get all emotional and whip around like crazy, but for that move to actually mean something, the bond market has to agree. It has to care. If bond yields aren't reacting in a way that confirms the economic story, the playbook is crystal clear. The move in stocks is just noise, and the trade is off. Full stop. No exceptions.
All right, so the prep work is done. Now we get to the really intense part, the rules of engagement. This is all about how you navigate the single most dangerous, most volatile period of the whole event, those critical minutes right around the 8:15 a.m. data release. And you know what the most important rule of engagement is? It might surprise you. It's to do absolutely nothing. Yeah, you heard that right. That 10-minute window from 8:10 to 8:20 a.m. is what the playbook calls the kill zone. It is a mandatory, hands-off, observation-only period. No jumping the gun, no guessing. Your only job is to sit back and watch the initial chaos unfold. You let the dust settle. Here, patience isn't just a virtue, it's your primary weapon. But even after you get through the kill zone, you're not out of the woods yet. The mission can still be called off. The playbook has a list of what it calls mission abort conditions, or hard blocks. Think of them as automatic safety switches. If the price moves way too fast, like more than 0.7% in just 5 minutes, the trade is off. If the market was too quiet beforehand or volume is super thin, trade's off. These rules are all designed to keep the trader out of messy, unpredictable situations where the odds are stacked against them. So let's say everything lines up. The pre-market checklist is all green. You've navigated the kill zone, there are no mission-aborting hard blocks in sight, all systems are go. What now? Now, and only now, is the trader authorized to actually look for a trade. And they're not just looking for anything. They are only allowed to take one of 3 very specific, predefined setups. These are the only 3 plays in the book. That's it. First, you have the break and hold. This is your classic continuation trade. The market makes a strong move and then proves it can hold that new level. Second, there's the sweep and reclaim. This is the opposite. It's a reversal play. It's for when the market makes a big move, but it looks exhausted, and you're betting on it to snap back. And third, the immediate failure. This is a super quick fade trade for when the initial move just gets rejected instantly. If it's not one of these 3, you don't touch it. Now, you're probably noticing a theme here, right? These setups are incredibly specific, and that's the real secret sauce. The strategy isn't some magic indicator on a chart. The strategy is the discipline.
This whole playbook is basically a system designed to manage the trader's own worst impulses and enforce super strict risk controls. It's not about making $1 million today, it's about making sure you survive to trade tomorrow.
And a huge part of that discipline is governed by one simple thing: the clock. The window of opportunity here is tiny. The trade window officially opens at 8:20 a.m. The primary window closes just 25 minutes later at 8:45. After 9 a.m., you are absolutely forbidden from putting on any new trades. And by 9:25, just before the real market open, you have to be reducing or completely closing out your positions. The clock is always ticking.
But wait, there is one more rule. It's a behavioral guardrail. And honestly, it might be the most important one in the entire playbook, and it can be summed up in just a single number. 2. That's the number. If a trader tries 2 of the legal setups and they both fail, that's it. You're done. The playbook is closed for the day. No third attempts, no let me just try to make it back revenge trading. This rule is brilliant because it accepts that, hey, sometimes the market just isn't cooperating. It protects your capital, sure, but more importantly, it protects your mindset from spiraling. 2 strikes, and you're out. Simple as that.
It's also really important to put this whole ADP trade into perspective, because it's not the Super Bowl. It's more like a preseason game. During a big labor week, ADP is considered a Tier 3 report. It's just a liquidity probe, a way to test the waters. Then you have JOLTS data, which is Tier 2, that helps validate the market structure. But the real main event, the Tier 1 regime driver, is non-farm payrolls. The results of the ADP trade never, ever override the bigger picture. And really, this entire complex playbook boils down to one simple mantra, a final operator's code that sums it all up. ADP tests liquidity, not conviction. Yields must care. Structure must hold. 2 strikes, and you're done. It's just such a powerful reminder that for the pros, a plan isn't just a nice idea or a suggestion. It's everything. It really makes you think, doesn't it? What could that kind of discipline do in any field?